Welcome back to the channel. Today, we're not just discussing a new SEC rule, we're talking about a paradigm shift, a moment that could redefine the entire future of digital assets and fintech in the United States. For years, the crypto industry has operated under the shadow of the SEC's infamous regulation by enforcement approach. The message to innovators was, at best, confusing, and at worst, actively hostile. But that era is ending. With SEC Chairman Paul Atkins championing a completely different philosophy, the agency is now on a clear path to introducing a groundbreaking policy, the Digital Asset Innovation Exemption. It's scheduled to begin formal rulemaking by early 2026, marking what the chair calls a move to create a stable platform for the next generation of finance. Why is this happening? Because the US realized it was losing the global innovation race. Talented developers, engineers, and companies were moving offshore, seeking clarity in places like Dubai, Singapore, and Europe. The SEC's goal now is simple: to stop the brain drain, welcome those builders back, and ensure America remains the global capital of digital finance. This exemption is their primary tool to achieve that. So, what exactly is this exemption? Who will it help? And what does a regulated digital future look like for you, the investor? Over the next 15 minutes, we're breaking down the three critical pillars of this new framework: the exemption structure, the interagency coordination with the CFTC, and the new roadmap for capital formation in 2026. Stick around, because if you own a token, invest in tech, or dream of building the next big thing, this is the most important regulatory shift of the decade. The term, innovation exemption, might sound abstract, but its purpose is highly practical. It's a regulatory sandbox for the entire country. Imagine a company has developed a new type of decentralized finance, DeFi, protocol or a tokenized real estate platform. Under the old rules, launching this product meant navigating a complex web of securities laws designed for stocks and bonds in the 1930s, laws that simply don't fit the technology. The innovation exemption is a temporary pass. It allows crypto and fintech firms to launch new products with lighter, more streamlined oversight for a specified period, typically while the SEC develops tailored, permanent regulations for that specific technology. The core idea is to create a minimum viable compliance environment. Firms can focus on building and gathering real-world data without the immediate, paralyzing threat of a major enforcement action. This isn't a free-for-all, however. SEC Chair Atkins has been clear that the exemption is a balancing act. It does not remove oversight, it merely shifts the regulatory focus from punitive action to responsible experimentation. For a firm to qualify, they must meet certain guardrails, likely related to transparency, capital maintenance, robust internal controls, and clear disclosure to their users. The exemption is primarily a tool to address the elephant in the room: digital asset classification. Is a token a security, a commodity, or something new entirely? For years, this ambiguity choked the US market. The exemption offers an interim solution, effectively saying, for this limited time and under these conditions, you can proceed while we work on the final definition. This regulatory clarity, or temporary safety, is what the industry has demanded for half a decade. We can't overstate the significance of this move. Historically, the SEC's approach to technology, dating back to the dot-com era, has been cautious and often reactive. This new posture is proactive. It's an explicit acknowledgement that the US regulatory framework is outdated and that waiting for Congress to pass comprehensive legislation, like a full-scale digital asset market structure bill, is simply no longer an option. The SEC is using its existing authority to create space for innovation now, rather than letting it permanently escape our borders. This aggressive timeline for rulemaking by early 2026 confirms the agency's commitment. You can't talk about digital asset regulation without mentioning the other major player, the Commodity Futures Trading Commission, or CFTC. For For years, the two agencies were locked in a jurisdictional turf war over which tokens were securities and which were commodities, an issue that became the ultimate drag on market clarity. The Innovation Exemption framework is intrinsically linked to a new era of interagency coordination. SEC Chair Atkins and the CFTC leadership have been holding joint roundtables specifically to align on definitions and supervisory frameworks. This collaboration is designed to create a unified rulebook for the industry, ending the regulatory ambiguity that has defined the last few years. This coordination is opening the door for products currently locked in regulatory limbo. Perpetual contracts, these popular, non-expiring derivatives are common overseas but have been largely restricted in the US. A unified SEC-CFTC framework could finally allow compliant perpetual contracts to trade on US platforms, repatriating billions in economic activity. 24/7 markets. Traditional US markets shut down at 4 p.m. Eastern. Digital assets don't. The agencies are exploring how to expand trading hours in a way that aligns with the global, always-on nature of crypto, while still maintaining investor protection standards. Furthermore, the SEC is not acting alone. They are working in parallel with Congress. We've already seen the passage of the Genius Act, which officially recognized stablecoins in US law for the first time. The SEC is looking to build on that legislative momentum. The ideal outcome for 2026 is a two-pronged approach. The SEC's Innovation Exemption providing an immediate operational pathway, while Congress finalizes a broader market structure bill to codify a permanent, future-proof legal framework. This simultaneous push is vital. This clarity is also a massive win for institutional finance. The new SEC has already approved the first US multi-asset crypto exchange traded product, ETP, using the recently published Rule 6c11. The Innovation Exemption ties directly into a new strategy to create generic listing standards for crypto ETPs. This means less, case-by-case, regulatory scrutiny and a faster, more predictable path to market for a whole host of new products, from tokenized securities to multi-coin funds. In 2026, expect the floodgates to open for compliant, regulated digital asset offerings on major exchanges. The Innovation Exemption isn't just a crypto story. It's part of a broader, pro-business mandate at the SEC focused on revitalizing US capital markets. Chairman Atkins has stated he wants to make IPOs great again. This requires removing bureaucratic friction that has driven startups to stay private longer or go public overseas. The SEC's Spring 2025 regulatory flexibility agenda outlines parallel efforts that will support the Innovation Exemption into 2026 and beyond. These are changes designed to streamline the process of raising capital for all startups, including those leveraging innovative technology. Updating exempt offering pathways, expect amendments to rules like Regulation A and Regulation D, simplifying the process for small and medium businesses to raise capital from private investors. This will directly benefit digital asset startups that use these exemptions for token sales or private fundraising rounds. Shelf registration. Modernization. Changes to make it easier and faster for larger companies to issue securities over time, reducing compliance burdens and facilitating rapid capital access. One of the biggest discussions involves the accredited investor definition. For years, this definition has largely been based on income or net worth, essentially locking out average Americans from high-growth private ventures. Congress and the SEC are actively exploring changes that would allow individuals to qualify as accredited investors through education, testing, or professional credentialing. If finalized by 2026, this change would massively expand the pool of accredited investors, fueling more capital directly into the companies leveraging the new Innovation Exemption. Atkins is also pushing to expand retail investor access to private companies and emerging technologies, including the possibility of allowing 401k access to certain crypto and tech funds. While this would come with strict guardrails and Department of Labor coordination, the intent is clear: to ensure that the wealth creation of the digital economy isn't limited only to the ultra-wealthy. The Innovation Exemption is the pipeline. The reformed accredited investor and 401k rules are the expanded access points for capital.